or their perspective of why the loans went back. And I'm sure you'll understand that your liability with a loan will not stop even after you have retired. So if you have given a loan till the loan gets repaid, there is some kind of an association which remains. And stringent recovery by the banking sector to track the resolution of stressed assets. So what is the way forward for the banks, for the bad banks? See, it has not been formed. Then it is a suggestion on paper which may materialize, keeping in view the kind of stress which the economy is facing. So what should be the backdrop under which the bad banks should be stressed? One important requirement which is being emphasized all over is you need to attract the right professionals who can work with the right dedication, who have the right knowledge, who have the right background. And this should be a start to finish project. It should not be delayed. So you say, okay, you start today, there is a timeline of 90 days. Not even like our insolvency and bankruptcy code. You know, there are no projects which have got sorted out. The process is going on and on and on. So have a definite timeline. The second is, yes, when the assets are transferred, they need to be at the right price. And you have to transfer those assets which have a chance of resolution. So let's not start the bad banks on a bad note. Then you need to allow the market to drive itself and recover the loans. Market should determine the price. We should not have A, B, C, D, which means influence of the price process. The price discovery mechanism should be free and fair. And the business model you set up should be a sustainable model. So that should be the basics behind the whole idea of setting the bad banks. I just thought I'll very briefly talk about the ISB code, which was set up in 2019 and 2017, sorry. It is said it's a time-bound process, but from whatever we read, I have not heard of maybe a case here and there, not the initial 12 cases or even the cases which came up later have been solved. So the whole code was to help, the companies who are unable to repay the debt. So whether it's the code or the insolvency professionals, they have not been able to solve the various issues which have come. Then we have the off-balance sheet items. I thought I must mention them because, when a loan goes bad, there are many reasons for it. And off-balance sheet items have become very important after the Enron debacle. It was completely due to the off-balance sheet item. So what are they? As chartered accountants or as finance professionals, all of us look at items which are in the balance sheet. Items which are in the balance sheet. For the last many years, notes to accounts. So I always tell my students, please read the notes to the accounts. That is where the story to the entire accounts and the balance sheet of a company is. Because the auditors may sign the balance sheet, but they have reservations, they're going to put it in the notes to the account. So off-balance sheet items, as the term states, they're not invisible. They're not disappearing. They are not recorded in the balance sheet, but they're recorded in the notes to the account. So I hope we know that items recorded in the balance sheets are completely determined by as per the IFRS rules. Even the format is determined. You go by, so there are about 5 or 6 items that appear in the balance sheet. On the asset side, then another 5 or 6 on the liability side. You can have subdivisions, you can have notes to the account, but the balance sheet has to look clear. It has to look neat and clean. So What are these off-balance sheet items? You cannot see them in the financial statement, but they are there in the notes. So that is why I wanted to emphasize that once we are talking of non-performing assets, we are talking of a bad bank, let us also try and get to the root of the problem. So at least some ways by which a correction can be maintained. Okay. Now, off-balance sheet items are mainly made up of two things: guarantees, which you give. So, for example, let's say it's a company A. You stand surety for another company B, and they have taken a loan. Now, you are good as long as company B keeps paying the loan. If they don't, then you are going to be liable, or there is some other warranty. Or let's say there's a lawsuit going against you. None of this appears in the balance sheet. But if something were to go wrong, the accountability will follow. Derivatives. Now, derivatives in any case do not appear on the balance sheets. Derivatives do not. They are off-balance sheet items. Whether it's a swap or whether it's a future or an option, they're all off-balance sheet items. But off-balance sheet items have become very important after the crisis. And many times, what happens is a company intentionally creates these off-balance sheet items. But if I talk of today's scenario, I mean, most of the companies have to operate with swaps. They don't have a choice. They're not doing out of any wrongdoing. Now, derivatives are important instruments, both to look at your spreads, to manage the various items in the balance sheet. So, these off-balance sheet items which are not listed in the balance sheet have become very, very important. Okay. Most of the companies do use these off-balance sheet items a lot of times to preserve borrowing capacity. For example, let's say your debt equity ratio is 1:1. That is the maximum which a credit rating agency will allow you to give you a AAA rating. You still need to borrow for a plant. What will you do? You create an off-balance sheet item. And many years back, companies would create a subsidiary. So they would create a wholly owned subsidiary. The subsidiary buys the asset, loans it to the company. So what is shown in the company's account? Only the lease amount, only the interest amount. Okay. So the important point which I also want to make is that these items are not invisible. They're disclosed in notes to the account. Okay. These are two examples which I want you to read to explain. So, see, the point is the concept of balance sheet items. The complex is not a very straightforward concept. We take a lot of time understanding it. So that's why I put two different examples here so that you read this. Should be a little more clear, and then you can, study this in a little more detail. But I didn't want to do the transformation road for Indian banking without mentioning at least the off-balance sheet items. This is the kind of example which I was mentioning. You need an asset, you take an operating lease, that subsidiary owns it, and it leases. It's only now, under IFRS now, if a company has 10 subsidiaries, it has to consolidate its position and show the balance sheet of subsidiaries in the parent's book, which was not there earlier. Okay. There's another example, which I've given here. So I hope you know, after the Enron debacle, we had the Sarbanes-Oxley Act. And again, US introduced it. A lot of our companies, because they have global operations, they're also using the Sarbanes-Oxley Act. Let me concentrate on the Basel norms. So this is something which we need to understand, because all our banks are following the Basel norms. Basel norms, as I said, set up by the Basel Committee on Banking Supervision. BIS is also a term used, Bank for International Settlement. So these are recommendations which provide the best banking practices on capital risk, market risk, operational risk, and so on. It is the Basel norms which were credited for telling the banking sector that you are facing other risks also apart from just the credit risk. You know, earlier, everybody thought the only risk which a banking sector faces is credit risk because they are giving loans. No, they are also facing something like an operational risk. What is the operational risk? Operational risk is about the system collapsing. And in today's context, like a cyber security, your data gets stolen or your MIS is faulty. Now, all that is a part of your operational risk. So all these are also risks which you are facing. There are 2 or 3 important dimensions of the Basel. Basel I and Basel II I mentioned very briefly. Basel III, I'm going to give you the highlights also because these are, I would say, comprehensive documents. But yes, you still need to understand and remember the takeaways. The point is, and this was again first emphasized by Basel, all assets listed in the balance sheet are not equally risky. So as I said, if my balance sheet total is 100 crores and there's another company's balance sheet whose asset total is 50 crores, doesn't mean I'm better off than Bank B, because I may be having more risky assets in my portfolio than Bank B. And I hope you understand. To give you an example, these were the risk weights which were given by Basel Accord. So cash in an ATM is probably safer than a subprime mortgage. So let's say a treasury bill or a short-term investment, little less risky. But if you have invested in, let's say, a company A, whose credit rating is, let's say, AAA, it's not the same risk as a cash or some other completely liquid cash. Or let me give another example. Let's say you invest in government securities or government bonds. This is not the same as investing in JP Morgan bonds. No? The two are different. So that's how risk weights are calculated. So risk weight is 0% when you invest in cash and government securities. Certain public debt, 10%. Interbank loans, 20%. And I'm sure you know all banks going for interbank loans. Residential mortgages, 50%. Private sector debt is 100%. We are not questioning them because these are the rules which are given by the Basel Accord, Basel, best banking practices. Basel had a lot of problems, or some problems as we like to say, but the most important problem which the Basel I had was one size fits all, which means by and large for all the companies, they gave one set of issues. Okay, so they say one size fits all is not right. There is a more complex risk weighting scheme, and that's what Basel II came up with. And Basel II was born in 2004. So they gave a more comprehensive risk weighting structure. Okay, risk weighting to the assets which were there in our balance sheet. More, in terms of your assets and liabilities, a complex weighting scheme. They also gave 3 pillars: capital requirements, supervisory, and market discipline. I'm not going into these details. But Basel II, as I said, is credited with telling us that banks face more risk apart from just credit risk. So they highlighted liquidity risk, credit risk, foreign exchange risk, interest rate risk. Interest rate risk was majorly emphasized because, prior to 1990s, when we didn't have this globalization and liberalization, everything was a stable interest rate. But the kind of volatility in interest rate you observe now was not there. In fact, in the last 10 years, you look at the kind of plotting you can have for interest rates. So, and why do banks need regulatory capital? So there were 2 questions which they tried to answer. risk-weighted asset and tiers of capital. Okay. And this tier, so this was a risk-weighted scheme which was given in Basel II. And all these are there in public documents. Residential mortgage, credit and auto loans, commercial, other assets. So all this was a risk-weighted scheme. So they realized all assets and liabilities in your balance sheet are not equally risky. The other concept which they talked about was tiers of capital. Tiers of capital implying the division was tier 1 and tier 2. Tier 1 is the safest capital, which means if a bank were to wind up, tier 1 capital would still be safe. That is my equity share capital, preference share capital, reserves, and so on. Tier 2 is your mortgages and other loans. So tier 2 gives me less degree of satisfaction. Tier 1 gives me a higher degree of safety. What is tier 1 and tier 2? So I hope you understand. Tier 1 is completely safe. Completely safe within a relative terminology. What constitutes tier 1? Equity shareholders, owners' equity, preferred stock, less goodwill, less intangibles. This is a definition given by Basel. Tier 2 is subordinate debt, plus convertibles, plus qualifying loans for loan losses. And the total capital is calculated as tier 1 plus tier 2. And I will also mention about the capital adequacy ratio, which is like the bottom line which the Basel Accord suggests. So when we had a Basel I, the capital adequacy ratio suggested was 8%. And let me also tell you, Basel Accord suggests a particular capital adequacy ratio for the European banks. RBI looks at it and says, should we increase it, should we decrease it, should we keep it the same? So 8% was there. There in Basel II also it was more or less the same. But in Basel III, RBI had increased this capital adequacy ratio. Let us straight come to Basel III. You know when Basel III was born? Basel III was born, and this I'm not saying only in India because Basel III are European rules. It was born after the financial meltdown. Because the financial meltdown and the banks are collapsing. The insurance company is being, they are relooking at it. So AIG was facing issues. It was nationalized. And there was so much of collapse in the banking sector. And I hope you know, the financial meltdown, the major sufferers were the financial services sector. So Basel III was born out of this. And Basel III, they refined the rules majorly. To give you a little idea, this, the focus of Basel III was how to make the banking sector safe, how to ensure they don't face systemic losses and systemic vulnerability, and how to ensure they do not face the financial stress. So the new guidelines which came up were more stringent, and they were more stringent for liquidity and leverage. In fact, Basel III is credited with having leverage and liquidity requirements, complete relook. Okay, so this is about a little about Basel III. So as I said, the focus in Basel III was to prevent any future banking crisis. And remember, I'm mentioning systemic risk, not systematic risk. Systemic risk is if one bank collapses, what kind of impact does it have on the entire economy? Okay. It is also designed to strengthen the cross-border banking system. Okay. So liquidity and leverage are two important components of the Basel III. So let me give you 2 or 3 important highlights of Basel III, which are a good takeaway for you. The capital adequacy ratio, which is calculated as tier 1 plus tier 2 divided by my risk-weighted assets. And if you don't want to get into the formula, because this is always given, capital adequacy ratio is the cushion to absorb losses in the banking system. This is one way of understanding this, the capital adequacy ratio. The other way of understanding capital adequacy ratio is a safety cushion for the banking sector. You know, Basel III has prescribed 9% capital adequacy ratio for the entire banking sector. RBI has gone 2 steps ahead. And RBI says Indian banks will need to adopt a capital adequacy ratio of 11.5%. Why? To strengthen the banking system, to ensure that we do not have banking, to ensure we do not have systemic failures. And if you read up a little background of mergers, you'll find that this is one important thought which has gone behind the mega mergers which have taken place. So this is what I'm mentioning here. Indian banks need to maintain a minimum capital adequacy ratio of 9%, in addition to a capital conservation buffer. Now, this is another term which they have used. I explained it also in one of the slides. Capital conservation buffer, which would be in the form of common equity at 2.5% of risk-weighted assets. In other words, the total CAR must be 11%, which is much higher than what banks they're required to maintain now. And please remember, for banks to maintain this CAR is not easy. But in terms of capital adequacy ratio, I can tell you, most of our banks are compliant. What is the CAR? So I'm intentionally giving it later so that we understand the significance of the capital adequacy ratio. You know, when we do a soundness test of the banking sector, we do a 1 ratio test, we see the capital adequacy ratio. This ratio tells us the strength of the banking system. So the purpose, as I said, is to protect the depositors. See, ultimately, who all have invested in the banking system? You and me. We would want our money to be safe. We would not want the banks to collapse. How is our money safe? By imposing stringent requirements. So what are the changes? So I have given you a little overview, but to put it a little systematically, the way Basel says, they talk about better capital quality. You know, they have a very strict definition. If you go into the details, a very strict definition of capital. And better capital means higher loss absorbing capacity. In fact, if you had read very recently, there was a circular which came up from RBI. Indian banks are not allowed to pay any dividends till they are compliant with all these rules. So till your capital adequacy ratio is what has been prescribed, till your capital conservation buffer, till your liquidity coverage ratio is as per the prescribed norms, you cannot pay any dividends. The idea is first build reserves and then think of paying any dividends. There is a term which they introduced, capital conservation buffer, which will be 2.5%. See, ultimately, if you look at the liquidity coverage ratio, which I have in the next slide, or the capital conservation buffer, or the better capital quality, the aim in all the cases is to ensure that the banks can absorb losses during periods of financial and economic stress. And what is a period of financial and economic stress? Something like what we are facing now. Okay, so leverage and liquidity ratios are 2 important highlights of Basel III. So there, there are no compromises on this. And under liquidity ratio, they've given a lot of sub-parameters. So remember, they're not giving one parameter, they're giving sub-parameters. LCR and net stable funding ratio. And all the banks needed to be compliant by 2019. Okay, so what will Basel III do? Basel III will increase bank capital, put a limit on banks' assets relative to the capital, ensure banks have enough liquidity, make banks stronger. What it will not do? It is not something which will take care of all risks. It will not remove the moral hazards and address systemic risk. This is a risk which worries all of us, like the pandemic. Moral hazard means I need to be ethical. I need to be compliant when I am giving the loan. It can't remove that risk. So that is up to the individual bank to ensure. Okay. So the whole purpose is that, this entire technology product innovation, sophisticated risk management system, generation of new income streams, building business volumes and cost efficiency will be or should be the new mantra for the banks in the coming years. So, the focus, I think, So the focus we have, or we should be have for the banking sector, in terms of going forward, should be to ensure that the kind of frauds we have witnessed, in fact, even last 2 years back, even last year also, there was some other fraud which was witnessed. Please remember, if it is credit risk, there will be frauds. But if we can minimize them, I think that will be a good way forward. So with all what technology has done, with the kind of advancements we have had, and we are very proud of these technologies also, let us ensure that the stability and the soundness of the banking system remains. It is not only for academic interest, it is even otherwise that the banks or the banking system is the cornerstone of any economy. And if the banks are sound, I think everything else can be taken care of. Thank you so much for your patient listening. And I'm sure you would, or you should be a little more, or you would have understood what will be the roadmap for the banks in years to come. Thank you once again.